Hey everyone, it's Gary. Hope you all are doing well. Welcome to this week's live Path to Prosperity webinar. I want to apologize again about last week. Turns out there was a system change to go to webinars platform. So Paul figured out what it was, and we believe we've got everything solved going forward. So I appreciate your patience from last week. So in any case, want to do a little bit of housekeeping here first. Let's just make sure, first of all, that everybody is okay. Hang on one second. Let me make sure I'm sharing my screen. Just the first thing. Let's make sure everybody's okay here. Nabeel, is that you?
Yes, it is.
How you doing, buddy?
I'm doing well, Gary. How are you?
I'm doing pretty good. Just going through a little bit of housekeeping here for a second. So hang on one second. So I'm going to send everybody a message here real quick. Hang on just one second. Can you see my screen and hear my voice? Okay, so if everybody could please just get back to me, type in your question box, let me know that you're okay on your end. We'll go ahead and get started here. So let's see, so far everybody's saying they're in good shape. Okay, good. So Nabeel, what I'm going to do is this. Let me go to the attendee panel real quick. And you and I are both on there. So I'm going to make you a presenter here in just a second. But before we do, guys, just a little bit of housekeeping. If you're new to the program, you'll notice that you're by default in mute mode, except for Nabeel and I. So you want to use your question box to pose questions. So tonight, Nabeel's going to be presenting, and I'm going to be facilitating. I'll be looking for the questions, and I'll field questions and post them to Nabeel. So, but going forward, always remember, whether you're doing this live, which is what we're doing obviously now, or watching it in recorded fashion, regardless, always get the email from Beverly the next day and go through whatever she has in there. She's usually giving you some type of an update on something, the platforms, the systems, the schedule, so forth and so on. So it's kind of important that you keep up with that. Usually a lot of questions, things that are changing that are going to be posted in that email. And you can use the question box here to post questions live, like I just mentioned a moment ago. So let's do this. Without further ado, by the way, let me just check here for questions real quick. We got, by the way, Nabeel, there's a lot more people registered for this week than last week because Beverly promoted it. So you got some more followers this week. And by the way, I just want to say welcome aboard to all the new folks and all the veterans too, obviously. But Bridget, good call today. Cedric, good to see you too, buddy. Javier, good call. That was the other day. Let's see. Karen, hopefully that email I sent you back helped you out there. Kobe, good call. Okay. Let's see. I'm sorry, Kobe. I'm sorry. We are your calls next week. That's right. Pam Reggio, good to see you. Okay, so let's do this. I'm going to go ahead and pass this over to Nabeel. So hang on just 1 second. Okay, make presenter. So Nabeel, you should have something popping up on your screen here very shortly. I think you have to accept it. And what will happen is everybody's going to see your screen. Yeah. And then we'll want to hear both of us, but they'll be watching your screen. So then you can take over from there. So everybody, just want to introduce you to Nabeel. Nabeel's one of our students going back about a year as a coaching level student, or what we call gold level, and is not only a real estate broker and investor, but also now has the ability to lend money to investors. So for all of us on the call here, most of us are investors, most of us are also agents, okay? And so if you have clients looking to fund deals, or you're looking to fund deals yourself, that's what this webinar is all about. So Nabeel's going to present to you in the next hour. So Nabeel, welcome aboard, man. I appreciate you taking your time to do this. I know you're a busy person, and it's a privilege to have you on the webinar.
And I appreciate time here on the webinar. I want to say hello to everybody who's out there and listening. Worked with Gary, like you said, for just about a year now, and it's been very helpful, very informative, and I don't think I'd be at the stage level now and presenting and also just kind of knowing a little bit more about me starting out if it weren't for Gary and the My Investment Services team. So big thank you to Gary. And without really much further ado, what I'd like to do is tell you about a little bit about the work that we've been doing here. A partner of mine who is unable to join today, she and I started Water Beach Capital, which is really, though there are several different ways that we're able to help folks out. We're very focused on the real estate investor financing market in particular. We help folks with, analyzing deals all the way through funding deals, and outside of the traditional hard money and buy and hold financing models, we work with businesses as well, established businesses, for them to be able to leverage their existing monthly and annual revenues into finances that are available and ready to go for investing in real estate. So without much further ado, I'll just get into the slide, and anybody who has any questions, of course, feel free please to use the chat function over here, and I'll be monitoring that as well. So
Okay.
company is Water Beach Capital, and we do a couple of different things. We are focused primarily on working with real estate investors. I don't know why. Oh, there they are. There it is, of course. We do a couple of different things, but it's all in the focus of helping real estate investors secure and also exit real estate investments. So that's me right there. Founded Water Beach Capital with my partner Rashini. And our mission is to understand the borrower better than any other lender in order to provide multiple solutions. And I take that mission very, very to heart, because for the most part, when we're working with whether they're lenders or investors who are focused on the real estate market, really, for the most part, they're out there to just really look at the deal and figure out if they can make money. And of course, everything in this world runs with, is it going to be profitable for everybody involved? But we've really set up our business in this lending side to be able to take a step back and offer different solutions, because there's really no one-size-fits-all model when you look at all the different situations that everybody's in. We do direct lending on residential investments. So residential encompasses all the way up to a 4-unit multifamily. So in that space, in 41 states across the US, what we're able to do is direct lend to residential investors. And outside of the residential space, we strictly broker. That's across residential, multifamily, commercial, and mixed use. I didn't quite include land, but we do have a couple of options available for land investors. But that's more than likely if they are, ready and able to provide some plans for new construction that they'd like to do. And we do also have options for gap funding. I don't always recommend that unless the deal itself, the real estate deal at hand, is a very good one. Because it's basically saying, hey, 100% leverage for 3, 6, 12 months, whatever it may be. So, but we do have gap funding available as well. And a little bit about ourselves, and what we'll talk about today is why you might consider Water Beach Capital. We're definitely not for everybody. A little bit about the programs that we do. We'll of course discuss some of the recent loans we've done, and in addition to being able to provide capital to real estate investors, we've been growing our business primarily by working with real estate agents as well as other mortgage brokers who are in the traditional mortgage brokering. Jack and Jill want to buy a house for themselves and their family. So I mean, we're very focused on developing partnerships, and that's something that we'll discuss a little bit later today as well.
Okay.
And if it's okay, I think probably a lot of what we all do here in the My Investment Services family is a lot of focus on the residential market, and probably progressively so also into the multifamily market. But we're going to talk about, if this is okay, just the work we do in the residential space, which is where we are direct lenders. And
Sure.
the difference, Gary, of course, between a direct lender and a broker is a direct lender is able to offer, the rates direct from the source of money, whereas a broker might be adding, a half a point, a point and a half, whatever it may be, into the fees. But on the direct lending side, we do residential. In our, I like to say, claim to fame on the direct lending side is that we offer this first bullet point here is the biggest, I think, the biggest point to take heed of. The lowest cash to close for investors to get into a real estate deal. And it translates also into more than likely, I mean, I say this in the case of probably 98, 99% of the loan options that are out there for investors, lowest cash to close and the lowest cash out of pocket throughout the entire course of the investment. We do that by advancing construction draws. And, I don't ever really expect anybody to understand the words I say when I say it just as advanced construction draws. But for the most part, when investors are going out into the market and getting loans for a renovation project, what ends up happening is they pay their down payment. And they'll get maybe 70, 80, 90% loan to value on the purchase price. And then what they're doing throughout the course of the renovation is paying a part of the renovation. We'll call it their first draw. And then the lender will say, hey, yeah, we'll check off all the boxes. You completed step one. We'll repay you for part one of your renovation budget. Now it's time to start paying part two. So you have to pay the next, 10, 20, 30, $40,000 out of pocket. And then they'll review that work and then they'll repay you at that point if you've done the work to their standards, and so on and so forth through the entire renovation project. We do it different. We don't reimburse folks their construction draws. Instead, what we do is we advance them. So instead of coming out of pocket that first $20,000, $30,000, we pay you that $20,000, $30,000 up front. You do the work. We review your work. If you've checked all those boxes, just like in the other example, we say, okay, your next $40,000 of work, we'll give you that $40,000 now, and so on and so forth, and through the entire project. And so that's one of the things that's been, very, very, very well received for the work that we do with investors, and it helps, folks, whether it's ranging from individuals who just don't quite have all the money that they might need saved up for a traditional real estate project to help them get through the entire project. And then it also helps, very seasoned investors who have a lot of deals going on at one time, and they're just kind of ignoring or passing by different opportunities that come their way, because at any given point in time, they look at a situation, they say, hey, I don't really have enough cash to go on, and we'll go into why this is the case, but on average, we're having people into deals maybe around 30 to 35, just right around 1/3 less cash required to get through a real estate deal.
Awesome. We know it's interesting, Nabeel, is we just in the last year, we've obviously had a lot of students who are flipping, and of course, their clients are also flipping, so this would help a lot. But in the last year, we've actually had people get into new development. I mean, just they're tearing down. You've seen this around Washington D.C. a lot. A lot of people are moving in, tearing down whatever's there, and building new on the lot.
We're at it. We're seeing that a lot, and I hate to do this because I know that you have a really good point probably coming up here, but another differentiating factor that I don't see that I put on here, and I should mention, we are one of the few lenders that will look at a project that has very high renovation and construction costs compared to the purchase price of a property. Usually if those renovation costs compared to the purchase price is 40% or so or higher, going to be very hard to fund, but we will look at those. And that's a lot of what we're doing here in DC, since you mentioned DC.
Awesome. Yeah. Well, same. I'm out in California right now, and the same thing's happening, around the greater LA metroplex. It's just wherever you have big cities with high populations, and there's what's called gentrification going on. So it starts in the center, it works its way out, but generally the older neighborhoods, people aren't just remodeling a house that's there. They're tearing them down and building new. It's just a cost. I mean, it's just what's worth it. I mean, instead of um, paying for a brand new construction directly, they'll buy this whole property because of where it is, the lot, and build new on it. In any case, just pretty neat stuff, and I think what you're doing is going to help that a lot.
It's who it's for. I always tell people, if I think there's a better choice, it's usually pretty obvious. But we definitely fit well for who we fit well for. We have a lot of different loan options available through just purchasing, flips, all the way through 30-year buy and hold rental finance. We do refinances as well. And then another kind of unique aspect of what we do, if there is somebody that you're working with, or you may be in this situation where you purchased a property and then you did that all cash, and then you realize, hey, maybe I shouldn't have done that. You can also refinance a cash purchase within the first 90 days of that ownership, just as though it were a brand new purchase, which what that really allows for is just a higher loan to value, a higher loan amount than what's typically out there. Purchases are usually considered more favorably as far as loan to values go than refinance.
Okay.
Bit of what we do. Minimum requirements. Of course, these slides will be shared. I apologize for any rushing I'm doing through these. Minimum FICO of 600 plus. That's for our direct lending. On the brokerage side, in some cases we can go as low as a 500 FICO score, but it is a little bit difficult. Unfortunately, we're not so different than other lenders that with the $75,000 minimum loan amount. I do know some folks will go as low as 30,000, but they're going to want to, see other properties owned and use those as collateral. And we're specifically working with business entities, and you can also see right here the states within which we don't work, with the exception of gosh, what was it, Arizona. I don't know too many folks who are working those other markets, but I'm happy to always just relay people to others if I can't help out.
Okay.
On the fix and flip side, this is really just kind of going over what I mentioned before. We're getting people to the closing table with less cash to close. The way that we do that is we advance those rehab draws, and we can even do that onto the HUD-1 statement. So at closing, we can, advance folks up to 15% of the closing costs out of the construction draw, or the construction portion of the loans. For anybody who has 10 or more flips or 10 or more currently owned rental properties, really what we're able to do is effectively provide people 100% financing. And down to about 85% effective financing at purchase. And I use that term as it's a very qualified term. I'm happy to explain to everybody how that works on a one-by-one basis, of course. I think this next slide. This is really kind of, I think, the most important part that goes over that loan to value and the effective loan to value description that I was talking about here, because we do have 4 different tiers of borrowers based on their experience in real estate, starting with the bronze tier all the way up through which is the top tier of the platinum. Bronze is representing the folks who have done, you know, anywhere from 0 to 1 flips or rentals within the past 36 months, all the way through platinum, where that's the folks who have done 10 or more flips in the past 36 months. I know a lot of people, for them, that's a full-time job. A lot of people, you know, that's even a part-time job to even get to 10 plus flips in 6 months, but it just kind of depends on the borrower, which tier they fall into.
Mm-hmm.
We have rates as low as 8% on the direct lending side. Also have to speak about lower rates that may be available to folks as a broker. But that's kind of the breakdown. It's a very typical and standard practice to see professional lenders giving loans out based on the level of experience that a borrower has, at least to achieve lower rates and lower costs throughout the term. Of course, there are folks who do 100% financing and such, but we're a little bit lower on the rates side in those types of folks. Like I said, we're very good for people with working capital concerns. A recent example of a project we funded is right here, where we had a gentleman who he was, I think he only had about 3 flips and investments in the past 36 months. We got him to closing with $144,000 cash to close on a over a $1 million loan, including the renovation budget, where the next closest competitor, who's actually a really great lender, if I may say, they're probably the biggest lender in the DC area on these fix and flips projects. But you know, we got him to cash to close $144,000 versus $196,000 at their shop, and you know, we're advancing his loans. We do rental financing as well, as low as 6% on the interest for 30 years. And it's actually a property that's not several blocks away from the one that I just described with a different investor. We had him at a slightly higher rate, and you know, I'd prefer to share at 7.875%. But in his case, that was you know, much better than what he would have had. And additionally, we're the most important point, we were able to cash him out and provide him the funds for him to close on another flip, which is really kind of the goal for a lot of folks, is to stack different properties if it at least fits within their financial model. And you know, I don't intend, Gary, to take up too much time, but I do want to, you know, advance to this slide and just kind of talk about the way that we've been growing our business.
Okay.
Is in working a lot with different players in the industry. I think we all kind of understand where we'd like to be within the industry, and we kind of understand what we're capable of at any given time, and are using our current you know, station within the industry to hopefully advance ourselves to where we want to be. I certainly am afraid to share that, you know, what I'd like to do going forward, well into the future, is to eventually get to the point where I'm developing commercial properties. And I know that working in financing side is has presented me already with opportunities that I'm taking advantage of to the best of my ability to get to that point, and developing a lot of really good relationships with folks that are here in the local DC, Maryland, Virginia. I've also worked much with folks in Texas and California, but I'm very focused as far as development goes and where I live. I've found lending to be a really, really great avenue into meeting folks, and it's something that can be extended to other players and you know, realtors and wholesalers and title folks and you know, residential mortgage folks as well, because the industry in which, you know, this hard money brokerage and investor oriented, that's a very important point, the investor oriented real estate financing industry is wide open for everybody to get involved. We've been working a lot with wholesalers, lenders, and you know, different entrepreneurs who are focused on the real estate industry. in partnering with them. If they're bringing us leads and folks who we close with, we're able to broker out a portion of our fees and a portion of additional fees that these other brokers would like to charge, if they would like to charge additional amounts. Lending on this investor real estate side is very good opportunity to just meet more folks, make a little bit of extra income, and the good thing is once you help somebody one successfully, for the most part, we're all in this industry for the long term, and it's a great source of repeat business. I'd love to chat with folks about ways that we can partner, because we are able to, on a continuous basis, partner up and work together to help real estate deals get closed. So I don't mean to take up too much time. That's my whole thing. I appreciate the time, Gary.
Yeah, no, that's okay. A couple questions.
Certainly.
So the one of the slides back a few slides ago, you had some of the states that were excluded from the one scenario, but overall, how many? So you have the direct loan. They can also partner with others. So in direct lending, these are the states that you're not currently operating in right now. But when you partner with other people, does that basically open you up to all the states?
Somewhat. If we're talking about this 4 unit residential,
Mm-hmm.
the reason why these states are excluded. Part of it is based on my relationship with Templeview, who is my direct lender, who I do the direct lending with, and
Mm-hmm.
is about the states, like these specific states. North Dakota, South Dakota, I think a lot of people stay away from those as far as the lending side goes, because there's a little bit less volume going there. But
Yeah.
as we're talking about Vermont through Utah, Minnesota, Oregon, Idaho, Nevada, Arizona, these are much higher. There's a lot more regulation in these states as it relates to being able to provide financing on real estate. So you could actually probably, depending on the lender that you're working with, you could probably add New York and
Mm-hmm.
California to this list of higher regulation industries. But like, for example, Arizona, both the brokerage and the individual originating a loan, and any individuals who are brokering a loan, they all
Mm-hmm.
need to have licensure, like you would expect any mortgage broker, the NMLS license. Um, you know, uh,
Mm-hmm.
Same goes with Utah. Utah actually, I think, is even a little bit more difficult than Arizona. So that's the reason why those states are, you're going to find across the board, anybody who's doing loans nationally for investor finance, it's pretty much the same states. Unfortunately, they're not covered by those folks, and they're really better served, unfortunately, or fortunately or unfortunately, by local players. I mean, I used to live in Minnesota. Minneapolis is by far my favorite place that I've ever lived, and I've only really lived in 3 places. I'm so
Mm-hmm.
sad. And the people that I know, who I was, I knew and I was working with while I was there, I really can't work with them because regulation is harder in those states, and so they just kind of all want to stay above board.
Okay. All right, that's cool. Now, as far as one of the things I've noticed, probably more so in the last couple of years, I mean, we've always had foreign investors, people from other countries investing in the U.S. And I know that there's certain banks that you have to go to that will do lending for foreign investors. But if you had somebody coming in from Europe or any other country, but Canada is a great example because we have a lot of Canadians down here investing in the States. Is there a way to accommodate those folks directly or indirectly through this?
Absolutely. I cannot do that through the direct lending, but I'll point anybody who has those questions to 2 different partners who I know. A lot of the reason why I think I've developed the different relationships on this lending side that I have, that's in result led to, for example, being able to lend and at least point folks
Mm-hmm.
in the folks who can help with international investors is because of all these states that we couldn't do. You know, if you put up a website and it says hard money on it, you're going to get a lot of calls from people from Arizona, a lot of calls from people from Nevada. And that kind of also resulted in finding a lot of international investors. You know, anything that I can't do on the direct lending side, I'm very happy to just point folks over to the people that we found that do some of these other concerns, international investors and those restricted states. It's not really restricted, but as far as I'm concerned and what I can do, they're restricted.
Yeah. Okay. Let's see. I've got a few more here. So obviously, the examples we gave were residential, anything up to including 4 units. But what if somebody came along with like a 10-unit building or something like that? I mean, nothing outrageous like 100 units, but you know, a lot of times what happens is we work with our clients and they start to grow and expand their portfolios, and they'll jump into like 5 to 19 units, for example, in which is, you know, obviously commercial. But are there any restrictions on that, or any particular states, anything you can think of, or is that like if somebody came forward to you with a, you know, a 12-unit building, for example, is it the same kind of processes, or what's anything different there?
Right. You know, so right now I'm working on I guess it's 20 units residential, 4 units of ground floor retail in North Carolina. That's
Okay.
for the most part, it's primarily, I guess we'd call it a construction loan, just because the construction value is very high compared to the purchase price.
Mm-hmm.
But once we get out of once we get out of the residential space, you know, it's just a matter of like, I'm very happy to share what I know with anybody who's on this call or who wants to, who's listening to this call later. We're happy to share, you know, a list of all the folks who do those directly, because, you know, that's an opportunity that I think everybody not everybody, but maybe 80, 90% of everybody who kind of starts out with these residential properties, they're looking at, hey, eventually I can get into commercial, and that's where things start getting really interesting. Rates start to get a little bit lower for the most part, depending on the type of project. You know, terms start to become a little bit more, I guess, a little bit less restrictive. There are a lot of companies out there that, you know, we could collectively broker together too. And you know, we started this company not in the hopes of making a lot of money. We started we started this company in the hopes of making a lot of relationships. So you know, commercial, mixed use, multifamily, land. There are a lot of lenders out there. We've kind of sorted through to the best of our ability. Everybody
Mm-hmm.
who's out there, very happy to share names and numbers of folks who can help out on those different product types.
Okay. Here's a question from Julie Calderon, excuse me. Have you ever considered doing cash out refis, or is that something on the horizon?
All day long, yeah. So if I go back to this gentleman over here, 1750, the guy who did 1757 A Street here. Right now, we're working on 3 different cash out refinances with him. One of them is a long-term cash out refinance. So he had already completed the renovation on what's that? What's that one? Actually,
Okay.
it's so weird because these are 2 different investors, but the one that he's doing is 1730 independent, where he's doing that cash out refinance. But regardless, that's going to be a 30-year loan, and then we've got 2 other projects with him where he's doing the refinance in order to just get short-term renovations. So we can do short-term cash out and we can do long-term cash out.
Okay. Well, that's actually pretty good stuff right there. I like the numbers here. Let's see. I think Julie had a follow-up question. Actually, same question. She's just asking about rentals that are completely renovated and rented, and I think that was one of your examples. Actually, On this one here, 1757 A Street Southeast, was that a multi?
So it's kind of a conversion. It's a condo conversion. So it started out as a row house, single family row house. We use row house. I know a lot of different areas use the word townhouse. DC has kind of got a huge shortage of housing. So what a lot of people are doing is they're converting townhouses into either two units of condos or three units, depending on what the zoning is. He changed 1757 A Street into two units. He's doing that as we speak right now. He's almost done with the work, but we can go up to four units if that was. I might be rambling. Is there maybe a better way I can answer that? I just want to answer it as best as possible.
No, that's pretty good. Yeah, she's also asking if it's you have to. So obviously this guy had some debt, but if they own them completely, like the properties are owned 100% debt free, well, obviously for you that's a much easier deal, probably, to cash out refi on. Does that
Well,
put you in first position?
if we go back to kind of what I was mentioning a little bit before, there's, anybody that you're working with, I guess I can somewhat understand why, and in other respects, I guess I don't understand why. But when you're doing purchase financing, you're always going to find it easier to get a higher loan to value. When we're doing refinances,
Hmm.
you can go up to, if it's a long term, 75% with cash out included, all the way up to that 75% amount. Where on our direct lending side, we don't really nitpick about loan to values and not loan to values, but like how much cash is coming out versus how much is the property worth. We'll go all the way up to that 75% cash out.
Hmm.
Uh, and then on the short term, I'll just be completely upfront. I think it's a better product for folks who want to use, or I guess who are doing the finance for the purchase, for the purpose of renovating. Um,
Yeah. Okay. Now that makes sense. And I know I don't know if you remember, Nabeel, I was a banker for 18 years in my past life, and I did the same thing. For some reason, when a bank does a cash out refi, even if the person owns the property completely free and clear of any debt, they still would be more conservative on that lending, as opposed to a new purchase. I don't have no idea why, because to me, I'm thinking, well, they've owned the property for a while. They don't have any debt on it, so that's clearly there's seasoning as far as paying off debt, seasoning as far as ownership. To me, it'd be a safer loan to make, but for some reason, they would usually come in lower on those cash out refis when a property's owned outright. I just don't know why.
I don't e- as long as because we do have different rates and terms based on how much the rent is compared to how much the expenses are. So a
Yep.
common term is debt service coverage ratio. But even regardless of the lower end of that spectrum to the higher end, we're still only really going up to 75% on the refinances. But
Yeah.
uh, I've been hard pressed to find anybody who goes higher than that anyways. Maybe
I agree.
a private individual might.
Yep. There was even a time when even the appraisals were coming in with lower values on the cash out refis than they were the new purchases. It's just something we noticed. But hey, let me ask you, when you're talking about the debt coverage ratio,
Mhm.
if you could talk a little bit about that, like what you generally look for, and does it vary by area and type of deal? And the other thing is, other than the debt coverage ratio, do you have a ratio of gross receipts? So if you have $10,000 in rents coming in, we plug in a fixed figure of 40% for maintenance and repairs and all the expenses, or how do you look at those rental properties, debt coverage ratio, and also what do you look at when it comes to the expenses that you generally see and that you want to plan on in your pro forma?
Absolutely. So I don't like to use words like loose, but we're pretty much the one of the loosest out there when it comes to what we're considering as a expense for getting to the debt service coverage ratio. So maybe it's good to take a step back and say, hey, what is the debt service coverage ratio?
Mhm.
we start with, how much rent is coming in, and then we subtract expenses. I'm speaking very vaguely here. My apologies. We eventually get to a net operating income, which is your pre-tax receipts or your pre-tax profits
Mhm.
for your debt service. So before your mortgage, it's the amount you're making before you have to pay the mortgage. That's your net operating income. So then what is your debt service coverage ratio? It's just saying, hey, you've got a mortgage amount of this much, you've got a net operating amount of this much plus whatever. Hopefully, of course, you're bringing in more than you have to pay in the mortgage. If you take that net operating income and you divide it by your mortgage amount, hopefully your number is above one. If your number is above one, that means you're making a profit. So our minimum debt service coverage ratio is of 1.00, and then our terms enhance, if you will, if your debt service coverage ratio is 1.25 or more. But it's a really important ratio, I think, for people to take note of. If you're probably not, at a debt service coverage ratio of 1.2 or more,
Okay.
on the way that we consider a debt service coverage ratio, and you're probably not in a very good deal. But Gary, because I didn't quite answer your question, all
Yeah.
that we are counting in our expenses for a debt service coverage ratio, all we're counting is what is your monthly tax, what is your monthly HOA, what is your monthly condo fee, and I feel like I'm missing something. Oh, what is your monthly homeowner's insurance? That's it. We're not looking at, do you have a monthly reserve? We're not looking at what are your utility payments, et cetera.
Well, that's pretty good. I know over the years, I've been through four different business cycles since I started investing, and a lot of times the debt coverage ratio varies. It's cyclical, just like the business cycle is. It goes up and down. So in really good times, it might be down to one you mentioned, or excuse me, tough times, and then good times it might be as high as 1.75. It just varies. So different lenders are different, but it's more likely reflective of whatever the economy is at the time. But
Definitely.
the fact that you're like not requiring reserves. I mean, a lot of banks, it's pretty tough. I mean, they're gonna, you know, they have their rates and terms in your payment, but they need a down payment. They have your reserves, and that's to not have to have that makes it a lot easier for our investors to keep going and growing a portfolio.
It's more common sense. I'll tell you this much. Like, there are ways that, um, you know, I've turned people away that we could have approved, because I've seen them kind of being on the brink, if you will. But
Mm-hmm.
there's, it doesn't have to be as hard as a lot of places make it to be able to, finance and secure things, whether it's for the short term or the long term. And we're really just looking at the deal. We're looking at if it makes sense. We underwrite the deal, as obviously a lot of folks say, but especially with the group that I'm with here at Water Beach Capital, like we have a lot of different options for people, whether we're doing it directly, whether we're doing it out of real estate, or we're doing other options. Um, if we go back to that whole mission that I was talking about, it's about understanding the borrower better than anybody else, and just seeing what works for them.
Yeah. What I like is I've dealt with a lot of banks over the years, big banks, small banks, um, and what I find out is the banks that do direct lending like this generally can be they're more likely to look at you and the merits of your project in and of itself, and they're looking for the how can we make this work um, solution. So the reason I say there's a lot of the bigger banks, they don't do that. They have certain silos and they have certain models to follow that they plug you in, and if you don't fit a certain model or format, they boot you out. And it could be a great deal, but if they don't fit their model, they just don't make you the loan. But I like what you're doing because you're looking at the project, and I've noticed banks that do that, typically they're portfolio lenders, often community banks. It's just always easier to work with.
And there's a lot of folks that we don't work with because they go straight to the banks. And if you can get a bank loan, I'm the first to say go get a bank loan, where it'll be cheaper for you. I'm not about
Yep.
trying to get people at a higher rate than they can get. It's just about if I'm a good option for you, go ahead and we've got a high level of service and everything. So.
Yep. Well, what I want to do is, if you could, you can go ahead and put this on the community site, because you're technically a vendor with this program, and that way it'll be out there for everybody to see all over the U.S. Of course, there'll be some Canadians taking a look at it, and also we have one guy actually in the Bahamas, so which is pretty neat. So, in any case, if you could do that, if you're not sure how to do it, just email Beverly and or Jody. They'll walk you through how to put that out there. And that'll get you some exposure there too. And everybody, of course, gets the recording of this. But so let me do one more quick poll of questions, make sure everybody's okay. So guys, if you have questions, now's the time to type them in, because we're going to be wrapping this up here in a second. I think we covered all the ones that I could see. Let me just go back through this. Maria's saying Palmdale, the audio is not. Hey, Maria, sometimes it might not be. What it could be is your internet server. I've seen this happen before. I travel constantly across the U.S. and Canada, and in some areas the internet service is better than others. It could be something associated with that, and that's why your audio has been kind of going in and out a little bit. But you'll get a recording. Let's see. Let's look for one more. See if there's any more questions. I think we're okay, Nabeel. Let me just double check. Yeah, I think we're all cleared on the questions. So I just want to thank you again for being part of this. I know you're busy, and please forgive us for last week. I just wasn't prepared for that.
No,
That you knew what to do. Yeah. So the good news is we made up for it this week. And for everybody, I think I say thank you for everybody that's was watching and was watching the recording of this. And just keep me posted how things are going, man.
Yes, sir. Of course, I appreciate that.
Yeah.
And
yeah. Hey, and by the way, I see your contact information here. Email, website, and phone number. So that's good. So when agents refer people to you, should they just do a direct referral, or is there any procedure, or just basically have them share your contact information, or?
Another of a procedure. Maybe I should have included that in here. We're going to have to sign a brokerage relationship document. So really what that does is it's just like, we're all real estate agents too. I started as a real estate agent. We know that when we sign an agency agreement, we're protecting ourselves and we're protecting our clients. That's the same general idea with the brokerage relationship that we set up through the document with folks who want to refer over business, protecting your clients, and that they know that they have a direct source, which is you, that they can go to, and it's protecting you as well, and knowing that anybody that you refer over our way, if we do anything untoward as far as trying to work with them, without letting you know or paying you on the back end, which obviously we would never do, it gives me recourse on the back end as well.
Okay, that sounds awesome. Well, all right, Nabeel, hey, good to talk to you. Good to see you. I'll be back in the DC area. I think it's going to be next spring. When I'm there, off and on, also because my dad, of course, lives in right below the Potomac, right past the Pentagon there near Shirlington.
Yep.
So, so I'll give you a heads up next time I'm coming in to visit, and maybe we can go out and grab lunch or something.
I can't wait. I really.
Yeah. But good stuff here. I'm proud that you're doing this, man. I love seeing agents branch out and be entrepreneurial and expand their field of vision. Number one. Number two is expand their sources of income, because having multiple streams of income, guys. I mean, Nabeel's living the model. When I was starting out years ago, I didn't have just a brokerage company. I had brokerage, I had title, property management, appraisal business. I mean, we basically had everything the client can need. So that's how you build more wealth and income, is have multiple streams of income, serving the clients in multiple ways. So kudos to you for doing that, Nabeel.
At the end of the day, folks that are doing all this investment work, really what they're looking for. Not that this is all that they care about, but really what they're looking for is money. That's kind of why I decided to plug in here. It's really expanded the network of folks that I've been working with since I did it. Like I said, it's not like we always are the best option for people. They make that decision, and sometimes I tell them we're not the best either. It's twofold.
Yeah.
Just talking to people about ways that they can fund their projects is a great way to expand and have different ways to talk to folks who are doing real estate in your area. That's what I found.
Okay. Awesome. Well, I appreciate that. So for everybody watching, listening, we will see you next week, Wednesday, May 1st, same time, 4 p.m. Pacific, 7 p.m. Eastern. Of course, you know, that's 6 Central and 5 Mountain Time. And thanks again, Nabeel, for doing this. Beverly, you'll get a recording coming out of this so you can use it to help your efforts for your promoting and marketing and so forth too. So,
thank you.
All right. You're welcome. Good night, everybody. Hope you have a great night. God bless you and your families. And we will see you next week. Okay. Bye-bye.